Hello. Well, what? I don't know if anybody can people hear me, because I can't hear Patrick. Hello?
I think Patrick has a problem.
Okay. Well, I think in the we're going countdown again.
Ladies and gentlemen, what can I say? Slight Wi-Fi error here in Valletta in Malta. Thank you very much, David Weild IV. We didn't intend to bring you into the show immediately. It's 6 o'clock in London. It's 1 p.m. in New York. It's 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending in the world you are. My name is Patrick L. Young. You've already met our illustrious guest this evening, David Weild. The IPO-VID Livestream Series 6, Episode 5. Ladies and gentlemen, this is number 35, starts here. Hearty congratulations to the company which reshaped much of the wagering market and introduced a meaningful risk transfer to gambling. Happy birthday, Betfair. They celebrated 21 years last week, and their coming of age looks like it might be coinciding with a renaissance in the United States of America for the sports prediction business. Over in Hong Kong, the Hong Kong Exchange is mandating diversity. In an attempt to throw off accusations of a sexist SAR, Hong Kong's boardrooms will have to include at least one woman by 2025, or listed companies will face penalties. The odd thing about the need to push for mandatory diversity is surely that the best companies make money by being diverse. And we all thought of Hong Kong as a den of shrewd dudes. Or at least shrewd dudes and shrewd dudettes. Speaking of which, the biggest advertisement for board diversity is surely none other than the chairman of the Hong Kong Exchanges Group, which are pushing for this board diversity move, Laura Cha. Meanwhile, Coinbase celebrated 60 days as a listed company. It began public traded life as the doyen of Young's pyramid, coming in at position 1. And when adding in all known dilutions, a $100 billion plus market capitalization was being claimed during the first day's trading. As we can see on the screen from Young's pyramid, it was well ahead in the lead compared to all those legacy exchanges, some of whom had been around for hundreds of years. However, that opening day on April 14th turned out to be a tumultuous pop. The stock has since traded 50% lower. After peaking at $429.54 on its debut, the company was resting at $223.92 after 2 months as a public company on the 14th of June. Not such great news for whoever was buying the stock in the high $300 mark and above. As you can see here from Young's pyramid, in fact, Coinbase virtually falls off the end of the screen if we're running any sort of a credit. It's now $10 billion below the London Stock Exchange Group. Coinbase nowadays a sub $50 billion company, which means that Young's pyramid, measuring the size of exchanges by operating company, has seen its erstwhile leader fall in 2 months to the bottom of tier 1, while pretty much halving in value. All this and more, ladies and gentlemen, has been covered in greater detail in Exchange Invest Daily, the daily unique newsletter of the Bourse business. Send us an email or hit me up on social media, Patrick L. Young, whichever stream you're watching this on, and we can get you signed up to understand the exchange business with a free 30-day trial. Our guest today, David Weild IV, is the man who has been, well, for many years, leading the crowd. He started in truly big banking. He's a former Nasdaq vice chairman. He's the father of the Jobs Act, which, as you may recall, is the act that brought crowdfunding to the United States of America, or at least securities crowdfunding to the United States of America before the good folks of Kickstarter get terribly antsy. This laid the formation for equity crowdfunding, and indeed forms of security token offering, STOs. David has been a leading advocate for public markets, transparency, and above all, access to capital for SMEs through large corporations. He's been at the forefront of the debate on listing in public markets for decades. The investment bank he co-founded, Weild Co, is revolutionizing investment banking by harnessing the power of the cloud, enabling qualified professionals to work from anywhere with a radically different model, enabling proven and independent investment bankers to better serve the growth and middle market economy. Along the way, David has priced over 1,000 equity offerings, and actually we're going to get to that in just a moment. Moreover, he's been everywhere and talked to everybody. He's testified pretty much throughout the world's different governments and parliaments, from the US Congress and the SEC to the G20, the OECD, the FEDSE, the Federation of European Securities Exchanges, where we met many years ago, and also the Arab Federation, and is, well, so frequently cited by regulators in different pieces that space just wouldn't permit us to even start referencing them all. Otherwise, we wouldn't have a chance to chat to David. David, good evening. My apologies for the hiccup earlier on. Where in the world are you today? Welcome to IPO-VID Livestream.
Great to see you, Patrick. I think the last time I saw you in the flesh, we were in Oslo, Norway for the European Federation of Exchanges a few years back. So it's great to see you. I'm in New York, by the way, just FYI. That's where I hang my hat. May not be doing that for all that long, since my last two kids are going to be off to college, and so we have a little bit of independence. And as you can tell, Weild Co is a decentralized finance model with investment bankers all over the place, and so there's no real reason for me to have to work out in New York. So my younger son is actually going to be at John Cabot University in Rome for a semester, so we may sneak over there for a little bit.
Wow, that sounds like great news altogether. If you sneak over to Rome, you're only going to be one short plane hop from Valletta in Malta. I look forward to seeing you here, David, at some stage in the near future.
You might have to do that.
And that sounds like a great idea to me. I mean, so you started out as genuinely, a big league investment banker. How, or indeed why, did you get into crowdfunding?
Well, I'm a data junkie, and I looked at the drop off in entrepreneurship, the rate of small business company formation, and as an old equity capital markets guy, as you pointed out, priced over 1,000 public equity offerings. You're a pretty good pattern recognition machine, and you start to connect dots. And you saw that when we went from telephone quoted markets to all electronic, penny tick size markets, it disintermediated the intermediaries and dropped the bottom out of support for small companies, which in turn cascaded down and killed the small IPO, which in turn started depriving smaller companies broadly of access to capital, which cut into the startup rate. And so as a patriot and somebody who believes in democracies and studied in Europe at the Sorbonne, at HEC in France, at Handels Hoog School and Stockholm School of Economics, and run businesses in London. I'm a big believer in sort of the democratic alliances and democracies, both in the in Europe, with the United States, and in Asia. And I sort of came to the conclusion that we broadly needed to get our act together, because economic growth, innovation, and ultimately national security is dependent on technology leadership, and a lot of that stuff happens with smaller companies. So if you're not, funding the entrepreneurs and the engineers at a competitive rate, you're probably going to relegate yourself to the dustbin of history. So that's what got me going. And I like to say I go down to Congress and I put my red, white, and blue epaulets on. I look to be very bipartisan, try and cut deals with folks that are going to move us forward. It's a painful process because of the dysfunction. We had actually another act in addition to the Jobs Act. We actually, for those of you that private resales in the United States, there's a safe harbor that was codified in the FAST Act 4A7 for those that are real securities geeks. We sort of used to gerrymander that, or abridge it with something called the 4A1.5, which was lawyers essentially giving you some comfort, but it wasn't an actual safe harbor to do a private resale of a company. that changed with the FAST Act, and then subsequently we tried to get a new form of stock exchange done with Congressman Emmer's office called the Venture Exchange. It was called the Main Street Growth Act. It was then bundled into the Jobs and Investor Confidence Act of 2018, which was actually even bigger than the Jobs Act of 2012. But it stalled when President Trump shut down the government over the wall, and what happened is it pushed the legislative calendar into the next Congress. But what was interesting is that it was heavily bipartisan. It was 406-4. So there's still an appetite, and I think that what we did, through our work hours and our so people at least sense how important this is. And for those of you in Europe, I mean, one of the challenges always in the European markets, and I've run businesses in London and elsewhere, you have a tendency to be much more reliant on bank financing than capital markets financing. In the United States, about 70% of finance has historically been done through capital markets and 30% through banks. I think you flip that number in Europe, and I think that that the challenge is if you can have more robust capital markets long run and take that pressure off, you probably do a lot to improve innovation and growth rates and the kinds of things that I think ultimately are going to be important to the free world.
So it's a big macro in every possible sense. I mean, it's the free world opportunity to manage to drive forward trade. It's a chance to manage to bring a lot more entrepreneurialism into the world. It's quite fascinating, though. I mean, you say you're a data junkie. I mean, how long did it take you to manage to see the data coming along that there was this hole in the SME market in, first of all, the US and then elsewhere?
Well, it was interesting. When I was vice chairman of Nasdaq, which is 20 years ago now, we went through what I call the bubble rubble in the wake of the dot-com bubble. We were seeing delistings of public companies at a very very fast rate, and I, in my mind, sort of attributed that to the loss of market maker support for these stocks, and when we converted from a telephone quoted market with quarter point spreads to a penny tick size all electronic market, and it actually started to occur. And the reason why it was never picked up before we did our work was in 1998 they implemented something called Reg ATS, which stands for Alternative Trading Systems, or sort of the electronic communications networks. It was the electronic central limit order books that people put up that were live. And so as a consequence, market makers were getting hit with live trades and they couldn't manage their risk. In the old telephone quoted markets, you could actually sort of just stay in the box at a bid, hold it there, and not actually have to honor a trade, get hit electronically. And so when that changed, it changed the economics dramatically of the business, and the Wall Street firms started pulling out of supporting these smaller capitalization companies. So we kind of saw it, felt it, but we had to go through a lot of data to be able to demonstrate, and in simple terms, that it really did happen and that there was a real reason for it. And that was the part that that actually required all the work. I mean, we in 2016, I think it was, I wrote a paper with two co-authors for the Organization of Economic Cooperation and Development, which is headquartered in Paris, called "Making Stock Markets Work to Support Economic Growth." And in it, we had an econometric multiple regression model, but essentially we're able to show that tick size as a percentage of share price, had about a 70% predictive value of the rate of small initial public offering activity, which is pretty healthy, pretty significant. Which says that the percentage value of share price that you can essentially earn through minimum tick sizes, that the magnitude of that as a percentage of share price has to be over 1% for market makers to get involved and to support outbound marketing. Smaller capitalization companies, or what we call asymmetrical order book securities, big seller, no buyer. And the problem today, or the challenge, is that when you kill the economic incentives to pay for research and outbound sales calls, you couldn't take a 500,000 share block of stock that on a stock that was trading 10,000 shares a day, hold the price steady, and then take it down and remarket those shares and say 500, 1,000 share increments and create spot liquidity to offset the sellers. As a consequence, these microcap securities have been really manipulated many times in the United States by illegal short selling that the regulators do a terrible job of enforcing. And you know, I'd like to say it's been kind of open season on many microcap companies. It's, you know, what's problematic is that a lot of the capital intensive businesses like life sciences, which are huge social impact, you don't have a harder time getting public, although some of the changes we made in the Jobs Act, including testing the waters, did allow, you know, for kind of crossover investors like big vertically integrated healthcare funds like Deerfield and Orbimed to come in and do a private round before they're public, create an imprimatur that, you know, that, if you will, technical due diligence that this is an attractive company, get a cheaper price in their portfolio and attract other buyers. So it's worked better than it has, but it's still not a picnic. And I think we still need a stock market that's really optimized to serve the needs of, say, sub-billion-dollar market value issuers, which we don't have. We have a one-size-fits-all stock market in the United States, and that's you know, in a word, it's dumb, and it hurts our long-term economic self-interest as a nation.
So fascinating, so many points there to draw out of the conversation. I mean, you're saying that the building of the nation itself, the growth of the nation is harmed by the inability for smaller companies to get onto the ladder, and we end up with a one-size-fits-all stock market, which is quite intriguing. Certainly fascinating to see how that has, well, quite changed the landscape since we went from 3/8 and 5/8 in a totally different world just a number of years ago. We got a question coming in on Facebook from, I do believe, Chico Echo. Where, David, is the biggest opportunity for crowdfunding?
Well, I mean, in the U.S., right, structurally, there's, you know, I think the best tool for crowdfunding is actually Regulation A+ Tier 2 offerings, which is something that, you know, may be a little bit of a curveball, but you can register, you know, with the SEC. It's actually technically an exemption for public registration. Sort of, it lives somewhere between private and public markets, but you can market to public investors, and you can restrict in the shareholder agreement so that the stock doesn't trade, or you can trade it and list it on Nasdaq. Once you do that, though, you become a fully reporting company once you list on Nasdaq or the New York Stock Exchange. So a lot of people are effectively going out and, you know, increasingly using Regulation A+, which has some reporting and filing requirements to raise, you know, bigger amounts of capital. And so in that regard, that's an opportunity. I mean, I would tell you that, you know, that if people are concerned about liquidity in the aftermarket, and that as a consequence of that, and microcap stocks don't trade well, you would end up, you know, probably doing best to use Regulation A+ for real estate transactions, REIT-type transactions, and things that have a yield associated with them, because they take on more bond-like characteristics. People are buying them for the yield and the total return, and they tend to work better. I think, though, you know, that we've got to fix the aftermarket support problem, and if we don't do that, you know, a lot of the pure stocks are going to be less attractive. By the way, in the U.S., they increased the cap on Regulation CF, which is crowdfunding, from $1 to $5 million, and but you know, the bigger opportunity in private markets, because there's no cap on it at all, has been through general solicitation of private placements under Regulation 506C. Hope that answered the question.
Oh, it's fantastic. So just to go back over that for a second, because isn't the issue with 506C and Reg A and so on, the problem is then that you have to be registered across pretty much all of the states, which makes it relatively tricky to start doing an offering. Is that right?
No, actually not. You know, a private placement, which is 506C, is exempt from registration. There'll be no aftermarket initially, unless you start to do things under, remember that exemption on private resales I talked about. You hold the stock for 6 months, and then if you find another investor that's accredited, you can cross a trade, and that 4A7 is the actual, within the FAST Act, the actual rule that allows you that safe harbor. In Regulation A+, interestingly, going out to the public, and on the primary, the original distribution, you get an exemption from Blue Sky if you do a Tier 2, which is for which means that you have to have audits, and you have to file with the SEC, and effectively be declared effective, and then you have a twice a year financial statement reporting requirement, but it's sort of financial reporting like compared to a traditional initial public offering in the United States. And in some regards, I think it's very effective, because at least then people know that they can find that information up on the SEC's EDGAR, creates some transparency. So it's a great tool to have in the toolkit. And I believe, the original cap on was 50 million per year under Regulation A+. I think it got moved up to 75 million, but you should check my facts on that.
Fascinating altogether. And actually, we've got a couple of interesting comments coming through. Thank you very much. I'm here,
by the way,
yes, sir, David.
$75 million US.
Yes, US dollars. No, that's okay. We presumed that was the case. The world's currency, truly, as we still haven't quite got around to engaging like El Salvador and taking on Bitcoin as our money. We got a couple of interesting pointers and questions. Actually, I'm going to come to Mike Velasco in just 1 second. I want to go to one of our favorite viewers, two-time guest on this show, Christopher Messina. Thank you so much, Christopher, for trying to help us out earlier on when we were having a few problems, when the entirety of Valletta's both systems with different providers went down in terms of our internet simultaneously. He's pointing out the fact that, well, in terms of matching large portfolio orders, you've just described crowdfill, which is one of Chris's very, very interesting processes and projects that he's been working on for a number of years. Good point there, Chris. Great to hear from you this evening. And we have a question from Mike Velasco. Are there any disadvantages to crowdfunding, David?
Well, one of the challenges when there are regulatory changes, legal changes in the United States, is it's people are very slow to adopt them, and the securities lawyers tend not to want their clients, their customers, to be the first ones, because they're afraid that the plaintiff's bar, will come out and and attack them. And it's a little bit like penguins at the edge of an ice floe, waiting for folks to jump in. I think we've gone past that right now. I don't think that there are any sharks in the water. People are using it, more. I think the challenge has been there's a lot of experimentation in terms of marketing. So I think that you end up with more shareholders on your cap table. That can be a challenge. But if you're okay with that, then I think that crowdfunding is a way to get businesses started for the right sorts of businesses, can be a great tool in the toolkit. And there's nothing harder than financing early stage businesses. I will tell you, one of the challenges is that still with crowdfunding, the way people generally get these going is through friends and family, and they start to show momentum. And then if you're on a crowdfunding site, you may see up 1/3 to 2/3 of the financing come in from people that were already on the site as members. That's the same in 506C, where they're registered on the site as accredited investors. And so getting that pump primed is the challenge for companies. And because it relies on friends and family, for anybody that knows anything about me, is I'm heavy social impact, and I believe in diversity, equity, and inclusion. I work with some prominent economic activists in the African American community, notably Rodney Sampson, the Opportunity Hub down in Atlanta. And one of the things that's challenging is that with the African American community in the United States, they are disproportionately poor. So getting, since your friends and family are also apt to be poor, it's hard to prime that pump to get, money into businesses. And I noticed that when I was speaking in front of an all African American audience, there's a lot of bright kids with lots of ideas, and it's even harder for them to get financed. So on the public policy front, I'd like to fix you know, what I'm interested in is when you've got $20-30 trillion worth of public equity capital, you know, all floating around in larger companies, primarily the Fortune, the S&P 500. How do you tip some of that down into the and make it flow into earlier stage companies and into communities that have greater need, so that they're not disadvantaged in terms of their access to capital? And these are greater sort of sociological questions that I think that we're gonna need to address. So, you know, so saying that, I mean, if you know, using crowdfunding and getting it started still requires, for the most part, friends and family, and so, you know, there's no shortcuts, and so if you don't have it, it's going to be harder to get done.
Really interesting, and very interesting how you've been engaging with particularly minority communities in the African American community in the United States of America. I know certainly there is a great difficulty there because, yeah, you can uphold several generations of a family, and between them they can't manage to get together to prove that they're one accredited investor, which obviously does make it a very difficult cycle of capital to manage to move forward. We got a fabulous question coming from London, Chris Pryor-Williard. Good evening, Chris. It's great to see you. Thank you very, very much for your question. Being such a loyal viewer, lovely to have you on the show. Great question. To what extent, David, is OTCQX a solution to the one-size-fits-all issue in the US capital market?
Well, look, I think that that the people that run the OTC markets have done a great job within the confines of what they have to work with, which is this, you know, the SEC's rule book. But, you know, they are still in the over-the-counter market subject to NMS, which and means competitive, you know, pricing. So they can't create a market structure that allows people to get behind it. And most broker dealers in the United States will not let their brokers solicit trades in over-the-counter stocks. So while it provides an alternative, you know, in order to get out there and get support for these stocks, it's a real heavy lift. And you know what I'd like to do with securities regs over the long run is to figure out how to get, you know, those market makers, those research analysts, and those sales professionals back into creating outbound sales in the secondary markets, the aftermarket, so that these stocks are better supported and defended against short sellers. So Cromwell Coulson is the gentleman that runs OTC markets. As I said, Cromwell's done a great job, but you know, he's got limitations in terms of what he can provide to those issuers, and I'd like to see it all improve, both for, you know, Nasdaq, NYSE microcap stocks. I define them as under $500 million in market cap, but all the way up to $1 billion, and in the over-the-counter market. I mean, we could do a lot of improvement in a lot of different jurisdictions, also in Europe. So, you know, we got a lot of work to do.
Yeah, there's a great deal of work to do, and it has to be said. I mean, the USA managed to move itself forward with remarkable alacrity a number of years ago and certainly get crowdfunding for equity going. Europe has been a much more patchy job. I mean, they've got this thing called the Capital Markets Union, which, good grief, I think your kids were, they were barely out of primary school or prep school at the time when they started talking about CMU, and you're talking about at least one of them studying this year. It's been ongoing for a decade without there being actually any great sign of it happening. Ladies and gentlemen, I'm with David Weild this evening. My name is Patrick L. Young. Welcome to the IPO-VID live stream. And David is here. He's leading the crowd, talking about crowdfunding for us this evening with some very good interaction so far. We'll get two super questions coming up. First one is going to be from Rombeat, and then we're going to have Chris Messina. Rombeat has asked us, good evening, Rom. It's great to see you again. Thank you so much for your question. How to run a successful equity crowdfunding? What is the optimal preparation time for a startup?
Well, look, I don't know that there's an optimal amount of time. You got to get your act together if you're going to be a reporting company and do honor to your investors. I mean, earlier stage companies, by definition, fail at high rates, and part of the reason is that they don't know, they don't have adequate sophistication on the financial team. I run into this all the time in our investment banking practice, where, I'll give you a number. There's a company called CrowdSmart out on the West Coast of the United States that does an artificial intelligence platform, collective intelligence, that helps people evaluate companies' investment opportunities. And the thesis is there's a lab running at MIT around this, where you seat a panel of 20 to 25 professionals. They do a 360 degree analysis, and one of the things that they find, not surprisingly, about that is a 40% predictor of success of getting financed in the next round is the quality of the financial staff. Are they sophisticated in raising money? Do they know how to report the books in order? They know how to run an investment process. And so many of these early stage companies, they think idea, and they don't have somebody on the staff where they do a fractional CFO, a part-time CFO, that doesn't know how to raise money. So I think my first recommendation is to get somebody that in shop, at least an advisor that really has done it before, that knows what they're doing, and because I don't think that this is something that you generally are going to do well the first time by yourself. The second thing you really need to do is you're going to get any of these crowdfunding sites. They look at the momentum that's being created, and people create momentum by bringing friends and family investors in. You have to bring them in to demonstrate some momentum on the financing. And then the third thing is that you have to be able to communicate very compellingly and succinctly what your business model is, and something that's going to resonate with the average person. And finally, if you have a business that has an affinity aspect to it, like a consumer business, sometimes your customers can also become your investors. And so, if, for instance, Seed Invest, Ryan Feit's company, got started essentially by working almost exclusively with consumer-oriented companies for exactly this reason. They had a client base, consumer client base, and they could go out and leverage that on the marketing of their crowdfunded deals.
Fascinating. Thank you very much for the answer, David. Thank you very much, Romby, for the question. Hope that helped you along there with the ideas that you're going to be doing, strengthening your finance team, making sure that you've got a sustenance to your business, not just a great idea. And also friends, families, and fools, always very, very important in an early round, amongst many other ways that you can manage to propagate your message out. Thank you very much to Marianne Madeira. It's great to see you on the show once again, Marianne. Really appreciate your remark there. Really inspiring IPO-VID. Thank you for sharing your knowledge, David. So thankful for the opportunity to learn from you. So praise indeed for you there, David. And we return to Christopher Messina once again in Florida this evening. David, what are your thoughts on the dangers of accelerating inflation when it comes to DFI into the US, and possible exhaustion of foreign interest in picking up treasuries at auction that the Fed doesn't want to buy?
Well, look, I think that if investors don't pick up treasuries, that creates a loss of demand, which means that relatively higher supply means treasuries are going to trade off, and they'll trade with higher interest rates. That in and of itself isn't necessarily triggering inflation. It's going to take costs up. Inflation, is something that you start to see right now, partly coming out of COVID, probably a bigger effect, and it's not just confined to the United States, where we are starting to get back to work, and we're starting to spend more money. Some businesses haven't been manufacturing. Supply chains, were somewhat compromised in certain instances. So there's shortages of certain kinds of goods, certain kinds of real estate, and we're seeing an escalation in price, which is, supply demand led. And I think it'll take some time for some of this supply demand imbalance to kind of be remediated, and we may work through it over the year. Now, this is my personal opinion. I'm not an economist, but it's I think that inflation, if you will, or that inflation threat is likely to resolve itself over, a 12-month or so period. Obviously, there's a lot of interest in crypto in general. By the way, for those, I was going to mention about Christopher. I should say, he's on my calendar tomorrow to talk about crowdfill, coincidentally. So I'm looking forward to seeing, what they're doing to help liquidity with microcap companies. But I also wanted to mention to people that I'm on the board of INX, which was the company that is creating registered exchanges in the United States. Very interesting case. I mean, it's run by Israelis. It's incorporated in Malta. It got the first IPO for a token as a security for an operating company passed through the Securities and Exchange Commission. It's raised money on the Toronto Stock Exchange, and so it's a truly international company. But they are setting up the first registered exchanges, everything through the front door regulation in the United States to trade crypto, trade tokens as securities and tokens as derivatives, which is, if you for want of a better description, is three separate, regulatory bodies in the United States. Obviously, tokens as securities would be regulated by the Securities and Exchange Commission. Crypto requires a money transmitter license in the United States, and then finally the CFTC for tokens as derivatives. So it's been a great journey. It's taken a lot of perseverance. It took us about 3 years to get that pioneering document through the Securities and Exchange Commission, and quite a lot of costs. So my compliments to the CEO, Shai Datika, for having that perseverance. I think, and by the way, when it comes to DFI, are we talking about decentralized finance? Is that what that?
We're going to get to decentralized finance in just a minute. So
yeah.
Let's move through maybe a couple of other questions at the moment, because we're going to come to DeFi in a moment, which will be relating to INX. Agata Bellon, she's got a great question. Good evening, David. Very fascinating discussion. Which company, startup, or individual would you say did a really impressive crowdfunding campaign, regardless of the type of crowdfunding, just the execution, the model execution?
I don't know that I'm prepared to answer that question. In all candor, I am, not, most of the financings that we do, are not crowdfunding. We've done, we do private placements, but we run things that are, usually in the range of $10 to $150 million in size. So, I haven't gotten in the weeds, but anecdotally, I've heard that things that are kind of really nifty, consumer products, things that have had the kind of the raw, product affinity have done extremely well. Real estate, because people want yield. I mean, the product choice for these companies is just as important, if not more important, than the campaign. But I'm happy if you want to share my contact information, Agata or anybody else to circle back with answers to questions that are maybe more fulsome and on point. Terrific. I don't want to steer you wrong.
Terrific. No, thank you very much. And thank you very much, Agata. I'm sure we'll hear from you in due course. So Nelia Mendoza, actually, she's asking a question more fundamental to your bread and butter these days, David. Can you explain the model of Weild Company?
Yeah, I mean, we're an independent contractor model. So all of our professionals we have a layer of people that support the field, and it's about 9 professionals supporting, going on 100 investment bankers and sales professionals. We are, we are highly decentralized, but we're a big believer in human capital to kind of kick tires, to get things done, to package deals. We're a FINRA member firm, so we're fully registered in the United States, and but our kind of idea is that we want to grow the heck out of it and get people back into the business. Women who left the business that worked at Goldman Sachs and had kids, their licenses expired. In the United States, your licenses expire after 2 years, or people that get aged out, but have a lot of fight left in them. Wall Street's notoriously ageist. A lot of investment bankers, are kind of gone at the age of 50, 55, but they're incredibly connected. And we've got some amazing people that have worked internationally. One guy that's a Japanese gentleman who is connected and advises the Japanese government. I mean, I like to say that some of the most priceless, most amazing Wall Street talent gets pushed out because they tend to age things down. So we're harnessing those individuals and their intellects. We're giving them an opportunity to collaborate with other people. We're starting to build sales groups. So ultimately, we're going to go from 100 to hopefully 1,000 professionals or more over the next 5 years, take the company public. And in the process, we're going to build out, and start to look like a major investment bank, but in the cloud, which would be the first one. That's the dream, built on independent contractors, people that want to take on a different, lifestyle. So I've got guys, working out of East Hampton and, in New York, in Colorado. I mean, you name it, down in Texas, just about everywhere. I mean, and it's growing rather rapidly. And as I think we've got one in license, so that they, with Weild Co, so that they can transact within the United States and solicit investors, because anybody soliciting in the United States, even on the institutional side, needs to be registered with a FINRA member firm.
That's fascinating altogether. I hope that gives you a good answer, Nelia Mendoza. Thank you very much, David. Leading the crowdfunding field the world over here, amongst other things, we're also been talking a little bit about crypto and token issuance. And that brings us to Alex Wilkinson's question. Good evening, Alex. Great to see you once again. So will DeFi, David, decentralized finance, evolve to become a real long-term source of small cap funding to the level where it can actively replace traditional broker and stock exchange roles?
No. I think it's a tool. Look, I mean, when we look at the blockchain, right? I mean, everybody looks at revolution, and we have the same thing going on in the internet. All these businesses ultimately depend on things that pre-existed. You can't do DeFi without the internet. You can't do DeFi without storage. So the building blocks were in place to kind of keep track of the general ledger. It gives you an incredibly interesting, cost-effective toolkit for all sorts of transactionally oriented businesses, right? And so I think that what's going to emerge from the primordial ooze, just like it did from the internet, maybe even second generation, we had the internet, we had eBay, we had obviously iTunes developed with Apple. I mean, some really pretty amazing kind of businesses, Amazon, Alibaba, and we'll see similar kinds of things emerge, and these toolkits will help entrepreneurs, particularly in fixed income and lending. I think because you can do things with credit analysis, but when you require a story, we still haven't seen any form of decentralized finance that doesn't include people, that does a good job developing trust and telling a story. We're doing some marketing, and maybe there'll be a generational shift over time where some of that marketing will be more productive in terms of bringing in assets. But so far, to bring in real money into small cap companies still requires humans to get on the phone with real investors that have real money that they trust, and to tell a story, to position it, and to follow up. And that's kind of the way that most business still continues to get done. It's still very heavily preferring human interaction. May change, but so far it hasn't. And so I think that the decentralized finance, at least from the blockchain standpoint, that doesn't use human intermediaries, is probably not going to be great on the equity side of the business.
Very interesting answer. Thank you very much for that, David Weild, and thank you very much, Alex Wilkinson, for the question. Most interesting discussion of DeFi. Now, Chris Pryor-Williard, he's going back to a more traditional view of the world. Nonetheless, he's a pretty revolutionary guy, as we all know. Is there a role for the erstwhile regional exchanges like Philadelphia, which Nasdaq acquired, and which those of us of a certain age remember as being particularly innovative with, well, things like currency derivatives in the case of the PhilX as well?
Well, I think that, you know, because of technology now, I think that exchanges of all stripes are regional in name only. You know, you can call something the Philadelphia Exchange, but you're still going to connect into it through New York or the Boston Stock Exchange. And many times, you know, what the big exchanges are doing in acquiring those regional exchanges is they're just laying their hands on the SRO designation, the exchange license, right? So in the United States, to be an exchange allows you to effectively set your own rules, and you are regulated directly by the Securities and Exchange Commission. And then alternative trading systems, or ECNs, and broker dealers are regulated by FINRA. FINRA reports directly into the SEC. And so to the extent that an exchange wants to open up a new business, it's a lot easier many times just to buy a regional exchange for the license. And I think that's a little bit of what you see going on. I think that, you know, a lot of those businesses or those exchanges will innovate and they will drive market share. I think you're going to see that happen where they could be ATSs, but you're going to see that happen in derivatives, in crypto, and in tokens of securities.
So it's quite interesting there, David. I mean, when we're looking at this and thinking about what's going on in these different markets and platforms, I mean, you mentioned the whole issue to do with regulated exchanges, and you talk about that. And obviously there are only a finite number of licenses, and I think they've all actually been bought up now by major companies, whether it's Intercontinental Exchange, whether it's Nasdaq or other parties pretty much. And we know it's difficult to get a new national stock exchange license in the US because we saw IEX essentially having to run the gauntlet of what was quite perhaps due to their model, but nonetheless they had to run the gauntlet of a lot of people in order to get the license. So do you think, therefore, the future of, say, secondary market trading for things like smaller issues may fall away from the one-size-fits-all model of the stock exchanges into the arms of the ATSs and those sorts of alternative trading systems?
Yeah, we're beginning to see that. You know, I think, you know, we'll see how it develops. But for instance, there's an ATS called Weild Co that's run by Sherry Noonan that connects into Core Connects. I'm an advisor to Core Connects, run by Oscar Joffrey out of Canada, and you know, they are doing something interesting in a multi-jurisdictional, compliant, you know, sort of marketplace where they don't actually use a hash or a token to trade. It's a closed system, but they are on the blockchain. And they just announced this past week that they are going to be allowing people that use their cap table ledger and other technology to trade their securities on their digital securities, if you will, on Rialto as an ATS. And so this is for, again, you know, emerging micro markets in the private markets. And so there's no question that there's a lot of innovation going on. I mean, there's a broader toolkit, and I think you'll see a lot of niche businesses. But you know, the history of this industry has been that when somebody gets up to a certain size and business becomes important, that they, you know, potentially will be acquired by, by somebody else. So there's, you know, constant sort of renewal and then consolidation. And I would expect that will continue. I would expect at some point that, you know, Nasdaq and the New York Stock Exchange, which have not yet listed a token for trading, that they'll figure that out. DTCC in the United States, which is the Depository Trust Company or Central Clearing, has not yet taken tokens on deposit into the DTC system. For those of you that have read Jeffrey Moore's book, Crossing the Chasm, on tokens of all sorts and crypto, we still have not crossed the chasm into the top of the bell curve, the broad mass market yet with any of these instruments. And I believe that what we need to see is the traditional exchanges figuring out how to protect investors and to list tokens, and then to get them into the central clearing organization so that a token or crypto can show up on your securities bank account, because there's a large number of people that would prefer to purchase things through E-Trade, Morgan Stanley, Deutsche Bank, you name it, then and have custody handled by Fidelity. Tom Jessup, I know at Fidelity, is a friend of mine, is running the digital business, terrific guy, and they're working on that. Or State Street, which are the big trusted names that institutions and family offices feel comfortable with, that they're not going to get fired if something happens. We still have real challenges in the crypto area with custody, and a lot of people just don't feel comfortable owning tokens in a cyber wallet, because they could do something stupid. They could get hacked. You saw the U.S. government hacked the ransomware Bitcoin that was extorted out of the pipeline company in the United States. And so there are some vulnerabilities. I think what we learned when INX went through the Securities and Exchange Commission is the SEC is very concerned that you have a mechanism by which if somebody loses something, it can be replaced. If there's a divorce, the assets can be frozen. I mean, all the historical protections that grew up in the securities industry over the last 100 years, they'd like to see that if we're doing tokens of securities, for example, that the public have those same protections.
So talking about those public protections, you were talking earlier on about the fact that people like negotiating things, and that was why you were not so convinced by the ideas that Alex was bringing forward for decentralized finance, interesting though there are. Robert Brown is asking a question. Good evening, good to see you, Robert. Is there a place, therefore, for peer-to-peer negotiated secondary trading platforms in the crowdfunding and related industry?
No, I think there is. I mean, look, there's something called call markets, which in Europe on the floor of the old Paris Bourse, you used to have a time during the day when people got together and traded a stock for a very narrow window because they were illiquid. And the theory was you want to pull all liquidity together in one place and cross it and close the market and then open it up again the next day. Whether it's negotiated, whether it's spot liquidity, it's issuing a call across a network to say, we have a seller, all that kind of stuff. But remember, you always run into sort of adverse trading, and what traders end up doing with these tools is a lot of times they feint in the opposite direction if they have a bit of common sense. So I'll advertise big buyer if I actually want to sell something, because I'm bringing in other buyers into the market. And we used to see that go on all the time on the trading floor. But fundamentally, if you want to create a real long-term buyer on an unknown name, somebody has to have a story, a view on valuation. They have to be able to tell that. They have to get the investor up the curve. And it has to be an investor that has some interest in the sector. They have to sell it, right? And I think that is the heavy lifting part that our regulators and our legislators just frankly lost sight of when they developed these modern electronic markets, which is many times they disintermediated the storytellers. And if you get into life sciences and medical devices and things, there's a lot of storytelling that needs to be done. Why is this company, undervalued? Why does it make sense? Where, what's the size of the market? Who are the competitors, right? And that's very hard for folks to do. You know, in micro cap stocks, institutions can't afford it because they can't get enough to matter. So, you know, you have to have the marketplace of analysts and salespeople, you know, accept that burden and create those markets. And right now, there's not an economic model, at least in the United States, and I think in most countries, to really, you know, do that heavy lifting and create buyers to offset sellers, which is what's really needed.
So therefore, yeah, there is quite an interesting opportunity for negotiating platforms, particularly where they can give you the opportunity to tell your story. So thank you very much, Rob Brown, for that question. Really much appreciated this evening. Now, we've got a question just going back a little step in the crowdfunding world. So Guyan Melvin Callahor, he's asking you, and I think this is possibly driven by the multitude, the sort of alphabet soup that we've been through this evening, because you have the Jobs Act, you have Regulation CF, you've got the 506c things, the Reg A things, and so on. And he's asking, you know, who can invest on a crowdfunding platform? And as I recall, it's kind of hashtag it's complicated with a few little carbuncles here and there.
Well, look, I mean, if anybody can invest in a Regulation CF business, you know, if you fill out the paperwork, it's not restricted to accredited investors. That's under Regulation CF, which stands for crowdfunding. And that is the one that is limited, I believe, check my facts, but I think you can only put $5,000 into it max. I think you, into any investment, and to 5 and from the side. Again, check my facts, because that was in the last year, I believe, increased from $1 million. Interestingly, the original cap that was proposed in Washington was 5 million, and everybody thought the world was going to come to an end if we let the public invest in small early stage companies, that there'd be all sorts of fraud. And you know, look, it's the world hasn't come to an end, largely because the numbers are just not, you know, enough to kind of you know, make a massive difference to an economy the size of the United States. But it is important to getting businesses started. The other areas which are under Regulation D, which are private placements, you need to be an accredited investor, right? And that's both 506B, which is non-generally solicited, and 506C, which is generally solicited. It's interesting, under 506C, you can market to anybody. But you have to make sure that the person that actually invests in the company meets accredited investor criteria. And I believe, and again, check my facts, that that's $250,000 in income each of the last 2 years, or a minimum net worth exclusive of your home of over $1 million. But I may be wrong. I may be light on that. But check it. It's you can look it up online, and you know, what are the criteria for being an accredited investor. I'm sure it'll show up all over the show.
Absolutely. And therefore, we've got a quick question coming also from Trixie Lopez, which is actually saying, can a crowdfunding platform keep my personal information secure? I think that's almost a regulation GDPR question for somebody in Europe. The answer is yes, because they're always go for a regulated platform. And we are talking about platforms that are regulated by FINRA in the United States of America. Whatever country you're in, you should be looking for the regulation of your local securities regulator, because then you'll have some degree of security about the investment and indeed about everything else. David, we started fractionally late. I don't want to keep you any longer, but I would just love to hear from you. I mean, you've got this fascinating investment banking model. You started by pricing 1,000 huge investment opportunities, IPOs in your career. You've been involved at all sorts of levels. You've been all around the world preaching the gospel of trying to promote crowdfunding. Tell me, what's on your mind? What do you think is going to be the most exciting thing, or what would you like to talk about over the course of the next few years?
Well, you know, we're starting something called the Jump Coalition in the United States, which stands for Jobs, Upward Mobility, and Making Markets Perform, to carry on the work. Our business, you know, Weild Co, is intended to fill that void. There was a collapse, you know, in middle market investment banks in the United States because of the, you know, the shift to electronic trading and the collapse in trading spreads. So we want to fill those voids. We want to, help drive economic, growth broadly through both our business and public policy, and really campaign around, a better, more inclusive, more economically successful world that embraces social impact and creates the kind of infrastructure that's required to leave a better future in the hands of the next generations. I think that, us in, people my age, we've been really lucky. I mean, if you think about it, my grandmother was a frontline nurse in World War I. My grandfather was a doctor. One of her brothers was killed at the Battle of Vimy Ridge in France in World War I. And then we had World War II, and yeah, we've had conflicts and things, but we've been relatively lucky. And so I think that given the rise of other powers, in Asia that have larger populations and are essentially autocracies or dictatorships, for want of a better description, don't share our level of freedom, we have a lot of work to do. And so I just like to, contribute by building a massive business that contributes to economic growth that hopefully, ultimately will go to Europe in a big way too. We'll have to figure that out, and Asia, and at the same time influence public policy in a way that creates these toolkits so that we all have a better quality of life and security to look forward to. It's important. And one of the things that I like to say about inclusiveness and why it's so important is that we have a lot of human capital assets that sit on the sideline, and for us to be really successful ultimately, we need everybody to be contributing to the best of their abilities. And so how we go about doing that is critical. I know the United States, one of the things that always troubles me is that we have the highest incarceration rates in the world. And that does not, that takes what could have been assets for society and turns them into liabilities, non-productive assets, actually liabilities that cost us money. And that's really sort of self-defeating. And so I think that we've got a lot to think about and to work towards improving ourselves. And in my country, I think we owe it to women and to minorities who have been underrepresented in industries like the venture capital industry, who are disproportionately, certain minorities, disproportionately poor, particularly African American community. And so I'd like to see others do well as a result of the work that we continue to do. And I think that if we can do that on a grand scale, I think that would be a real cherry on the ice cream sundae of my career.
David Weild, thank you very much. Ladies and gentlemen, we've been with David Weild for the last hour, leading the crowd in so many ways through diversity, social impact, and of course, crowdfunding itself. As a self-confessed data junkie, that's how he managed to move from doing the very big deals on Wall Street, $1 billion plus, to trying to help in the smaller markets, Reg A+, CF, and all of those sorts of different areas. And of course, as we were talking about Reg A and 506C rule markets altogether, are we crossing the chasm in terms of crypto? Well, we were sitting talking about how the token economy needs greater adoption as we go along. And of course, there was also that critique of the one-size-fits-all US market. as we're looking across his portfolio of interest, Weild & Company, a fascinating new model for investment banking, which encompasses the entirety of the United States and actually is reaching out towards the whole of the world for $10 million to $150 million deals and beyond. It's a fascinating world, ladies and gentlemen, through the Jump Coalition, which he's currently trying to build as he works towards leaving a better future for the next generation. How we all echo those words as a true social impact for the benefit of markets. David, thank you very much for being with us today. Thank you also to all of the people who've been asking questions and engaging with us. Chris Messina, Ron Beat, Chris Pryor-Williard, Mike Velasco, Chico Echo, Marianne Madeira, Agata Bellon. Good to see you all again. Alex Wilkinson, great to see you too. Nelia Mendoza, Rob Brown, and Trixie Lopez. It only remains for me to say that next week we're going to be having an absolutely fascinating guest, which is going to be Christopher Giancarlo, who's looking ominously a little bit like David Weild, actually, in that picture. Somebody may have got their data mixed up there. I think we've got a slight data point problem. Apologies for that, David. We're looking forward to the former chairman of the CFTC, Chris Giancarlo, next week. It only remains for me to say I'm Patrick L. Young. Thank you. Catch up with us during the week in Exchange Invest. David Weild, you have been leading the crowd on IPO-VID. Thank you very much. Ladies and gentlemen, have a great week in life and markets.
Great to see you, Patrick. Thank you.
Thank you.